If you are looking at silver right now and you see a price hovering near $81, I need you to stop what you are doing and listen to me very carefully. What you are witnessing is not a market correction. What you are witnessing is not natural profit taking. What you are witnessing is a coordinated psychological operation, a trap so sophisticated that 95% of retail traders will fall for it in the next 48 hours. They will sell their positions. They will lock in losses. They will hand their metal directly to the institutions that engineered this entire move. And by the time they realize what happened, silver will be trading above $90, and it will be too late to get back in. I am going to prove this to you with data, with volume analysis, with historical precedent, and with the exact playbook that the banks have used for decades to separate you from your wealth. But before I do, you need to understand something fundamental about how markets actually work. Markets are not driven by fundamentals. They are driven by liquidity. They are driven by order flow. They are driven by algorithms that can see exactly where your stop-loss orders are sitting and can engineer moves specifically designed to trigger those stops, create panic, and buy back your shares at lower prices. This is not conspiracy theory. This is market structure. This is how the game is played. And if you do not understand the rules, you cannot win. Let me set the stage for you. Over the past 3 weeks, silver has been on an absolute tear. We broke through $75. We smashed through $80. We hit $83 and held that level for multiple sessions. Momentum was building. Volume was strong. Every analyst was talking about $85, $90, maybe even $100 by spring. The technical setup was perfect. The fundamentals were screaming. Industrial demand is at all-time highs. Solar panels, electric vehicles, 5G infrastructure, all of it requires massive amounts of silver. Mine supply is declining. Primary silver mines are shutting down because prices were suppressed for so long that they became unprofitable. The supply-demand deficit in 2025 was 200 million ounces, the largest in recorded history. And that deficit is growing. Central banks around the world are moving away from the dollar. China imported over 6,000 metric tons of silver in January alone. That is more than 3 times the entire monthly global mine production. They are hoarding. They are stockpiling. They are preparing for a world where commodities, not currencies, are the foundation of trade. Everything was pointing to a major breakout. And then, in the middle of the night, while most of you were asleep, the price dropped $1.50 in less than 4 minutes. No news. No Fed announcement. No geopolitical crisis. Just a sudden, violent drop that triggered thousands of stop-loss orders and sent retail traders into a panic. Here is what actually happened. At exactly 6:47 in the morning Eastern Time, someone sold over 8,000 futures contracts in a single block. That is 42 million ounces of paper silver dumped onto the market in 4 minutes. To put that in perspective, global silver mine production is roughly 850 million ounces per year. Someone just sold 5% of annual global production in 4 minutes. The price instantly collapsed from $82.80 to $81.50. That is a $1.30 drop on 8,000 contracts. If you were long and got stopped out at the bottom, you just lost $54 million. But here is the key. The entity that sold those contracts did not care about the loss. They were not a seller. They were executing a strategy. They sold to trigger stops. They bought back at the bottom. And they pocketed the spread as panicked retail traders dumped their positions in sympathy. This is called stop hunting. And it is one of the oldest tricks in the institutional playbook. Now let me show you the smoking gun. Look at the volume. During that 4-minute drop from 82.80 to 81.50, total volume was 11,000 contracts. Compare that to the rally the day before. Silver climbed from $81 to $83 over 6 hours, and that move involved 87,000 contracts changing hands. Do you see the asymmetry? It took 87,000 contracts of genuine buying pressure over 6 hours to move the price up $2. It took 11,000 contracts in 4 minutes to drop the price $1.30. That is not natural market behavior. That is algorithmic suppression. That is a coordinated strike designed to break momentum and shake out weak hands before the real move begins. And the reason it works is because most traders do not understand what they are looking at. They see red on their screen. They feel fear. They sell. And the banks laugh all the way to the vault. Let me explain exactly how this works, because if you understand the mechanics, you can never be fooled by it again. When you place a stop-loss order on your brokerage platform, That order sits on the exchange as a pending instruction. If the price of silver drops to your stop price, your shares are automatically sold at market. You set that stop to protect yourself from losses. That is the theory. But here is what you do not know. Market makers and algorithmic trading desks have access to order flow data that you will never see. They can see exactly where stop orders are clustered. They know that under $82, there is a massive concentration of retail stops. Thousands of traders who bought silver at $78, $79, $80 set their stops at $81.50 or $81.75 to lock in profits or limit downside. The algorithms identify this level. They calculate the minimum volume required to push the price down and trigger those stops. They execute the trade. And then they sit back and watch as the stops cascade. The first wave of stops triggers. Those become market sell orders. Those market sell orders push the price lower. That triggers the next layer of stops. It is a cascading effect, a liquidity avalanche. The algo only needs to initiate the move. Retail traders do the rest of the work by panic selling into the decline. Once the stops are cleared and the price stabilizes, the algo buys back the contracts at a lower price. It is mechanical. It is not emotional. It is a computer program designed to exploit the predictable behavior of human traders. Now let me show you why this strategy is especially effective in the silver market. Silver is a tiny market. The total value of all the silver ever mined in human history is roughly $1.4 trillion at current prices. Compare that to gold, which is $15 trillion. Compare that to the S&P 500, which is $45 trillion. Compare that to global real estate, which is $330 trillion. Silver is microscopic. And because it is small, it does not take much capital to move the price. A single hedge fund with $500 million in assets can move silver significantly. A sovereign wealth fund with $50 billion can dominate it entirely. So when you see 42 million ounces dumped in 4 minutes, you have to ask yourself, who has the capital and the motive to do this? The answer is the bullion banks. The answer is the market makers who are short silver on the COMEX and need to suppress the price to avoid a squeeze that would force them to deliver physical metal they do not have. Let me give you the exact numbers so you understand the stakes. According to the latest Commitment of Traders report, commercial traders, which includes the bullion banks, are short 294 million ounces of silver. That is 58,800 contracts. At $83 per ounce, that short position represents a $24.4 billion liability. Every single dollar that silver moves higher costs the shorts $294 million. So when silver rallied from 80 to 83, the shorts lost $882 million on paper in one day. They are highly motivated to push the price back down. And the easiest way to do that is to engineer a low volume drop in the overnight session when retail is not watching, trigger stops, create panic, and cover part of their short position at lower prices. This is not speculation. This is documented. This is how the game works. And the only people who do not know about it are the people getting fleeced by it. Now let me show you the technical pattern that confirms this is a trap and not a reversal. When a market breaks through resistance, the first pullback to test that former resistance as new support is called a breakout retest. This is one of the most reliable bullish patterns in all of technical analysis. We broke $80 resistance. Now we are retesting $80 as support. If you zoom out to the 4-hour chart, you will see that $80 is acting as a floor. Every time the price dips below 82, buyers step in aggressively. Look at the candlestick wicks at 81.50, 81.60, 81.70. Those long lower wicks are evidence of buying pressure. Someone is defending this level. Someone with deep pockets and a long-term strategy is accumulating every single ounce that panic sellers are dumping. And when the weak hands are finally shaken out, when the stops are finally cleared, the price is going to explode higher because there will be no supply left to absorb the demand. Let me give you 3 historical examples so you understand this is not speculation. This is pattern recognition. In March 2020, when silver crashed from $18 to $12 during the COVID panic, the lowest volume day of the entire crash was the day silver hit 1177. That was the exact bottom. Why? Because the real sellers had already exited. The move from 12 to 1177 was pure algorithmic stop hunting. 2 weeks later, silver was back at 16. 3 months later, it was at 28. If you sold at 12 because you thought the world was ending, You missed a 133% rally. In November 2016, after Trump won the election, silver rallied from 1750 to 1920 in 2 days on expectations of infrastructure spending and inflation. On the third day, silver dropped from 1920 to 1810 on no news. Volume was half of what it was during the rally. Retail panicked. They sold. 2 weeks later, silver was back at 1950 and went on to hit $21 by January. If you sold at 1810 because you thought the rally was over, you missed the next leg up. In September 2022, silver rallied from 1760 to 2040 as the Fed signaled a pause in rate hikes. On the pullback to $19, volume collapsed. Retail sold. 3 months later, silver was at 24. Same pattern, same playbook, same result. The banks engineer a low volume drop to trigger stops. Retail panics. Banks accumulate. And the rally resumes stronger than before. Now let me show you the volume profile for today, because this is where the evidence becomes undeniable. Total volume on the SLV ETF, which is the largest silver exchange-traded fund, is down 64% compared to yesterday at the same time. Yesterday, at this point in the session, volume was 11.8 million shares. Today, it is 4.2 million shares. What does that tell you? It tells you the big money is not selling. Institutions are not exiting. This drop is a technical shakeout, not a fundamental reassessment. If real money was selling, if institutions were dumping their positions, you would see 20 million, 30 million, 40 million shares trading. You would see every silver mining stock down 5, 10, 15%. Instead, look at what is actually happening. First Majestic Silver is down less than 1%. Pan American Silver is down 1.2%. Wheaton Precious Metals is flat. The miners are not confirming this drop. That is a massive bullish divergence. When the underlying stocks refuse to follow the commodity lower, it means the smart money knows this is fake. It means they are holding, and in many cases, they are buying. Let me explain why the banks are so desperate to keep silver below $85, because this is where the real danger lies for them. Right now, the open interest in out-of-the-money call options is at historic highs. The $85 calls expiring in March have open interest of 32,000 contracts. The $90 calls have 19,000 contracts. The $100 calls have 11,000 contracts. That is 310 million ounces of silver that could be claimed if those calls expire in the money. The COMEX warehouse has 290 million ounces of registered silver available for delivery. Do you see the problem? If silver breaks above 85 and stays there, the shorts are forced to deliver more silver than exists in the warehouse. They will have to buy physical metal on the open market to cover their obligations. And when they start buying, the premiums on physical will explode. You will see American Silver Eagles selling for $15, $20 over spot. You will see dealers with empty shelves. You will see a two-tier market where the paper price and the physical price completely disconnect. This is the scenario that keeps the bullion banks awake at night. This is why every dollar silver moves higher is a battle. This is why they engineered this drop at 6:47 in the morning when nobody was watching. They are trying to prevent a gamma squeeze that would destroy them. Now let me address the psychological warfare that is being waged against you right now, because I know exactly what you are feeling. You saw $83. You felt good. Maybe you told your family you were right about silver. And then this morning you woke up to $81.94. Now you are questioning everything. Maybe I should sell before it drops to 78. Maybe this rally was just a short squeeze, and now it is over. That is exactly what they want you to think. That is the entire purpose of this operation. They are not trying to make money on this $1.30 drop. They are trying to break your psychology. They are trying to make you sell out of fear so they can buy your metal at a discount before the real move begins. Let me tell you something. The fundamentals have not changed. Global mine production is still declining. Industrial demand is still exploding. Central banks are still buying. China is still hoarding. The supply-demand deficit is still growing. Nothing has changed except the price on your screen. And that price is a lie. It is a manipulation. It is a trap. Let me show you what is happening in the physical market, because this is where the truth lives. While the paper price is being suppressed, physical premiums are rising. Dealers are reporting strong demand. Some products are on backorder. The disconnect between paper and physical is widening. This is exactly what happened in March 2020 when the paper price crashed to $12, but you could not buy a silver eagle for less than $22. The paper market collapsed, but the physical market stayed strong because real buyers understood that the crash was fake. They bought aggressively. And 6 months later, they were sitting on massive profits while the people who panicked sold were left behind. You need to ask yourself a very simple question. If silver is really collapsing, why are the miners not selling off? Why is physical demand still strong? Why is volume so low? The answer is because this is not a collapse. This is a shakeout. And if you sell now, you are handing your position to the very people who engineered this move to steal it from you. Now let me walk you through what happens next, because understanding the sequence is critical. Right now, we are in the consolidation phase. The price is bouncing between 81.50 and 82.50. The algos are clearing out the stops and establishing a new base. Once the stops are cleared, there is no more supply to push the price lower. At that point, the buyers who have been waiting on the sidelines step in. They start accumulating. They push the price back above 82.50. Once we reclaim 82.50, the technical picture improves dramatically. The moving averages realign. The momentum indicators turn positive. And then the algo flips from suppression mode to acceleration mode because algos do not have a directional bias. They are designed to extract profit from volatility. On the way down, they trigger stops and buy low. On the way up, they trigger short covering and ride momentum. So once this consolidation is complete, the move higher will be fast and violent. The same algo that engineered this drop will fuel the next rally. Let me give you the exact price levels you need to watch. The key resistance is 82.50. That is the volume-weighted average price for today. If we reclaim 82.50, that signals the buyers have regained control. The next resistance after that is 83.20, which was yesterday's intraday high. If we break above 83.20, the next target is 85. And if we break 85, there is no resistance until 88 because that is the next major psychological level. The path from 82 to 88 is wide open once this consolidation completes. And I will tell you right now, I am watching this chart tick by tick. I am monitoring volume, momentum, order flow. And the second we reclaim 82.50 and hold it, that is the all-clear signal. That is when you know the trap is over and the breakout is resuming. This isn't just about silver. It's about the future of the entire financial system. China is preparing for a world where the dollar no longer dominates. They are stockpiling commodities, copper, lithium, rare earths, gold, and silver, while the United States has drained its strategic reserves and outsourced its supply chains. As geopolitical tensions rise, America is realizing how dependent it has become on rival nations for critical materials. Silver is no longer just an investment. It is a strategic asset, and its current price does not reflect its true value in a world where commodities are weaponized. Even the Federal Reserve has admitted that traditional tools no longer work when shortages are driven by geopolitical hoarding. That means rate hikes won't stop prices if major players are buying everything available. This is why banks fight so hard to control paper prices. A true physical repricing would expose how fragile the system really is. It would force a global reset across currencies, bonds, and stocks. Meanwhile, institutions continue to accumulate. Funds like PSLV show steady demand, proving real money isn't panicking. Only retail traders are being shaken out. Smart investors stay disciplined by weakness and hold real metal. Fear sells. Data wins. Most people keep asking the same question. If this opportunity is so obvious, why isn't everyone buying? The answer is psychology. Humans are wired to fear losses more than they value gains. Losing $100 hurts twice as much as gaining 100 feels good. So when accounts turn red, panic takes over. Algorithms understand this perfectly. They create false breakdowns designed to trigger fear, force retail traders to sell, and hand cheap assets to institutional buyers. The only way to win is to recognize the pattern and refuse to react emotionally. History proves this again and again. In 2016, silver collapsed, retail sold, and prices surged months later. In 2018, the same thing happened. In 2021, it happened again. Every cycle looks identical. Retail panics. Smart money accumulates. Price explodes. This isn't coincidence. It's strategy. And it works because most traders lack patience. As for me, I'm holding every ounce. I'm buying dips. I'm ignoring noise. I'm waiting for true revaluation. The window to buy is closing. Once momentum returns, Prices will move too fast to react. Premiums will spike. Supply will vanish. Fear will cost people fortunes. Discipline will create them.